Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We love talking about small cap stocks on Fear and Greed. There are some really interesting stories, and it's always good speaking to professional investors about the opportunities they see at the smaller end of the market. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Dermot Ryan is Portfolio Manager at Renaissance Smaller Companies Fund. Dermot, welcome back to Fear and Greed.
Thanks, Sean. Wonderful to be on your show again.
How are you seeing markets in the Aussie economy at the moment?
Look, at the moment, we've got very macro-driven markets. There's a lot of noise and chop around inflation rates. We're 18 months into a global rate hike cycle. And, fundamentals seem to have gone out the window on the stock market as a result. We're seeing consumers and investors fret about these higher interest rates of what they're going to mean. We're starting to see the global indicators, starting to slow down because of the interest rate brakes being applied. And, this is something we saw in the US about a year ago, where consumer spending kind of screeched to a stop there when they were around the same interest rate levels. And, it's fair to say it's happening here now. And we're seeing a number of similar kind of retail profit downgrades coming through from our local retailers in the same way as we saw, Walmart and all the other US retailers do the same last year. What we find is these induced slowdowns take a few steps or a little while to set in. At the start, people don't notice the interest rates going up. Then they start to panic about maybe the size of their mortgage or their interest bills. Then they start to pull back on spending. But after a while, they start to work around these things. We've seen from the ABS stats, a lot of people going to get a second job or doing more hours at work. And, things kind of settle down after a while. In worst case scenario, people will sell some assets to get their debt position right. But eventually things settle into a new equilibrium and, demand and inflation should normalize in that event.
Okay, so let's bring on to the market. And, we're here to talk about small caps. Where do small caps fit into that scenario? They've certainly underperformed large caps in the last little bit.
Yeah, I think because we've had a very prolonged interest rate hiking, it's a couple of 50s to start and then 25 points for a month on month. There's been kind of a long, slow bear market. You haven't really noticed it, but the Small Ords are now down about 25% since the start of 2022. That's at 20% underperformance from large caps. And that probably is because smaller companies don't have as much pricing power as larger companies and maybe have to compete harder to get good staff. And so they're a little bit more vulnerable. But what we see is that when the market turns, they tend to turn and move up faster than large caps. And, we think at the moment, the crowds and investors are a little bit worried about where the short-term earnings are going. But, often this is the time where you start to get long-term opportunities. Australia just went over 4%. We're at 4.1% on the cash rate. But similar kind of economies like New Zealand are at 5.5%. And the US is 5.25%. So, we're a long way towards that pinch point where the economy will settle down and inflation and economic activity kind of get to that new equilibrium. But during that kind of intervening panic, there's often really good opportunities to buy companies with good industry positions that are growing earnings, positive cash flow, and importantly for this part of the cycle, low debt. And those are the kind of companies we're looking for at Renaissance.
Okay, so tell us, can you name some of the companies that you're looking at that have those characteristics?
Absolutely. We've got a number of stocks in the portfolio that kind of fit that. When I talk about kind of maybe some of the new opportunities that we're seeing at the moment, I really think that there's this end of financial year stock take sale going on in the retail sector at the moment. I mentioned, this happened a year ago in the US, and what we've seen more recently has been a huge number of downgrades in the last couple of weeks in domestic retailers. We've seen Wesfarmers, Baby Bunting, Universal, Accent Group. We've seen DJs, they're not listed, but they're apparently double-digit sale declines. So we're seeing some opportunities starting to emerge there. As I mentioned last year in the US, what we saw is that That downgrade cycle broadened a little bit as the economy slowed further. So what we're trying to do there is start to line up some targets in retail. We have been looking at some, American exposed companies. One of them, to give you an example, would be City Chic, which is a apparel retailer. They had excess inventory. They're a year kind of further down the track in the US. So, they're actually trying to work through that inventory cycle and coming through in a bit of a turnaround on the other side of that retail slowdown in the US. And investors like ourselves and actually Brett Blundy, the kind of famous retail turnaround investor, are both buying some shares there. We're also looking for kind of opportunities in that retail space that may not be as impacted with the over-levered cohorts. And that's an area we're working at. We're not really stepping in and buying there, so I won't give you any other retail names yet. I mean, the other opportunities that we're seeing at the moment really are kind of more on the resources side.
Go on.
We're also in a resource bear market. There's been a lot of slow economic data out of China. They're now stimulating again, as well as the Western world is in a slowdown. So at the moment, during this slowdown phase, we're buying a lot of gold stocks, and we have been since probably September last year. And we think they've got good appeal. If the slowdown kind of decelerates faster than people think. But we think, as we get on later in the year, we really are looking at kind of opportunities in battery minerals again and outside lithium. Lithium was a kind of 2020 to 2022 trade.
Yeah.
But we think, things like copper, nickel, even zinc, finding companies that can get through the next year but have got expandable production and new projects coming through. We really like them. But in the meantime, it's probably the gold names that are still in the ascendancy. We've got almost a record Aussie dollar gold price. And, for our domestic producers, there's been some terrible quarterlies up until around now, but we think they're going to get better as, COVID interruptions and labour force shortages ease in Western Australia. So, we think some of the Gold Road and Ramelius and some of these stocks that we've got in the portfolio are kind of well positioned in the short term.
Stay with me, Dermot. We'll be back in a minute. I'm speaking to Dermot Ryan, Portfolio Manager at Renaissance Smaller Companies Fund. Okay, so far we've been talking the retail stocks, the mining stocks have been very linked to the economic cycle. What about opportunities that are less dependent on the cycle?
Yeah, I suppose, small caps is all about the individual stocks. It's less about the macro generally, but, there's always individual opportunities that you can find in the market. One we're invested in at the moment that we like is Austal. They're the shipbuilder. They've got operations here and also in Alabama. And, they are after signing a $5 billion deal with the US on naval vessels. They've got a number of different bids in place as well, which might bring them into submarines. They've got enough work on hand for the next 5 to 10 years at what will likely be pretty good margins. And what we're finding is a lot of, there's a bit of a build-up in defense spend with the geopolitical tensions in Asia. And we think they're just very well positioned now to finally be at kind of full capacity on their shipyards. We've seen the stock starting to run. And, there was even a few rumors last week. There was a US private equity firm looking to buy in some or maybe make a bid for the company. But, we think that's a good stock in this particular environment. And it's, trading below replacement value, and we think a good opportunity for medium-term grower that can grow independent of the economic cycle.
Okay, I think you're a bit of a fan of SDA Health too, aren't you?
Yeah, well, SDA Health's kind of another one of those examples. This is an aged care stock. It's the kind of largest listed player in Australia, and they're underbid at the moment by Bain. But that's a similar kind of a story. And we bought that stock in the middle of COVID. A lot of people were worried about what the impacts of COVID were and whether their patients would get infected or how they'd staff their facilities. And the stock just dropped precipitously during that period. But, thankfully we were able to build a big position in the stock, and, we're now selling it for more than double, just 3 years later. But, we think even the bid that Bain started the bid at $3, have just raised to $3.20. We think that barely even covers the replacement cost for that business. So, there's still potentially some upside there, and a frank dividend before it goes. But, I think that's another example of just these idiosyncratic opportunities with asset backing that you can find, if you can try and not, sift through the panic, I suppose, and just find assets that you want to own.
The moral of this story, it seems, or at least the moral of this interview, might be it's time to have a look at small caps again, Dermot.
Yes. Well, I think, we're probably not at the bottom, but it's always hard to to catch that bottom of the markets. But, there's good reasons to believe we're kind of getting closer to that inflection point. I think inflation and interest rates are going to be nearing their peak. We think that once that initial pullback in spending is done, the market and economy will settle down, and people will get used to the new disposable income that they have, and we'll start to move forward. I mean, if we look at the US example we were talking about earlier, the US Russell 2000 retraced about 25%, and it's actually been rebounding. It's rebounded about 10% in the last 2 months. So, it takes a few months for these things to play through, but you've got to get positioned before they turn back up. And it's always a good idea to start to step in before that recovery comes through, so you're in the market.
Dermot, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Dermot Ryan, Portfolio Manager at Renaissance Smaller Companies Fund. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.